Good morning to everybody. Thank you for joining us today. Last year and a half, we've obviously seen an environment of high inflation, rising interest rates, all of which have led to a very different mortgage market to what we sort of became used to and accustomed to over the last decade. I'm very pleased to be joined by our resident lending expert, Matthew Cuoghi, who's here to help sort of guide us through some of these changes and hopefully provide some useful guidance for those of you out there who maybe considering remortgages or new lending and need a bit of a helping hand. I'm Chris Hallam. I'm a chartered financial planner and director in our financial advice team. I'll be your host today. I'm going to be putting some questions to Matt throughout. Bit of sort of housekeeping first. If you all look to the bottom of your screens, you should see a Q&A function, a little button at the bottom of the Zoom call. We'd love to make this as interactive as possible, so please ask your questions as you go along. We've had a couple submitted in advance, so thank you for those. We may not be able to answer them all on the webinar, but any that we don't, we'll follow up with. And of course, Matt and I are always available if you want to sort of approach us separately and have a conversation about anything. So, Matthew, welcome.
Yep. Hello. Thank you, Chris.
Thanks for joining. So I think really the first question for you is what's been going on recently, and if you can give us a bit of a background before we dive into some of the details.
Yeah. What's been going on? Mortgage brokers have been busy and slightly stressed for about a year and a half now. Of course, the main piece on topic is inflation. So that's not going to be the new conversation. What's quite interesting is what's going on with inflation and how that starts to feed into the base rate, and then indirectly mortgages. So we've obviously had inflation which has massively crept up. The Bank of England has had to shoot up the base rate to start to try to curb inflation. Unfortunately, or frustratingly, inflation has been quite stubborn to come down. So unfortunately, on that aspect, the Bank of England has had to continue increasing rates. So previously, we were expecting the base rate to come to around 4.5% to 5%, but inflation just wasn't playing ball. So the Monetary Policy Committee, and then by proxy, the Bank of England, had started to put rates back up, and we're now around 5%. This is, of course, shooting up from our pretty historic lows of 0.1% last year. So what does this mean? That's where we have sort of come from very succinctly. The market is currently pricing in 6.5% base rate by the end of the year. Now, that's not gospel. Don't take that by word, because this is changing week by week. But it's an interesting one to keep an eye on. As of last week, we had inflation news come out, which was more positive. So actually, the market has started to change tack and potentially considering the base rate may not peak at 6.5%. It may be slightly below that. So we're at 5% now. We've got another meeting next week, which is coming out on the 3rd. So Thursday, the market is pricing in 5.5% of a base rate increase. Again, this is all what market expectations are coming back at. So take this all with a pinch of salt. September, it's coming in at an extra 0.5, so up to 6%, and then 0.25% in November and again in December. That's what the market is currently expecting. Whether or not it pans out like that, it's all dependent on the inflation news as that starts to come out.
I mean, with all of this in mind, there's going to be a lot of people out there needing to remortgage or perhaps kind of considering new lending. So there's going to be some decisions for people to make. I mean, I think the first question we hear quite a lot from clients who are coming in is, should I be fixing my rate, and if so, for how long? Is it the right option, or is a tracker rate more appropriate as we have continuing changing rates? I mean, where's your view on that?
There is a sentiment, or there is an argument to always look at cash flow, and rather than saying, well, what do I do now? Look very much at the longer term. Look at the next 5 to 10 years. we need to make sure that the mortgage is affordable, of course, in the shorter term, but actually you don't want to put yourself in a position where in 5 years' time, you're still stuck on a really high interest rate. So do you fix? Well, how much can you afford is the short answer. That then starts to guide your decisions. If it's already quite tight, actually, what's more important, time in the market to try and get a slightly better rate, or fixing it for a period of time to make sure, regardless whether you've got a broker like me sat at the opposite end of a screen saying rate's going to do X, if they do the opposite, you know you can still afford the mortgage month by month.
I mean, that's quite a good point on affordability, because one of the other sort of big considerations for clients at the moment is between interest-only mortgages or repayment mortgages, and where in the past with historic low rates, repayment mortgages have been relatively cheap. Now with rates sort of up 5 times from where they were, potentially repayment mortgages have become a lot more expensive. So how can interest-only mortgages play a part in helping this?
I think interest-only mortgages can be very useful if you need that lever to reduce how much you're paying for a shorter period of time. Then it may be a solution to have an interest-only mortgage to span that initial couple of years. So it may be that you look at a fixed rate for a couple of years with an interest-only element to reduce the cash flow in the shorter term, with a view longer term and having that plan that you will then switch it back to a full capital and interest repayment mortgage. There's also the option of looking at something called a part and part mortgage, which is, it's not much creativity in the mortgage landscape. Part of it is interest only, part of it is capital repayment. So you're still reducing some of what you're paying, but you've still got that certainty that the element on repayment will be repaid at the end of its term. Just moving back a bit. So that's very much fixed rates. The other alternative is variable rates, whereby of course they will vary. So if I'm completely gold correct here and the base rate goes up to 6.5%, of course the variable rate will follow that. But if you're trying to keep flexibility so you can swap in and out of mortgages, maybe you're going to move in a few months, maybe you're going to be selling the property and looking at other plans, a variable rate may be quite useful because they don't carry early exit fees, or a lot of them don't carry early exit fees. We're also seeing, so again, another step back to interest rates. We're seeing the producer PPI, producer price index, that's come down massively, which is the cost of generating and basically manufacturing goods. It's just not yet quite feeding into CPI. So we always look at cash flow. What is affordable? If it is affordable and you potentially want to take that risk, maybe, and see if you can try and secure a more temporary rate, and then in a couple of years' time, fix to a longer term, that could be an option as well.
I think sort of with my planning hat on here, when we have clients talking about interest-only mortgages, the potential repayments are such a long way into the future. The actual need to finance that final repayment gets lost a little bit. I mean, as far as sort of repayment vehicles go and planning for that final sort of eventuality, what are clients sort of looking at doing on this?
Last year, it was quite an easy answer. It was, your mortgage is going to be around 1 to 1.5%. So can you arbitrage essentially and make your money work harder than repaying off a mortgage? Again, short-term view would say, well, actually your money probably quite useful going into the mortgage at this stage. But again, that's short-term. Longer term, 5 to 10 years, and looking at your financial advising hat, you may not necessarily want to put all of your liquidity and capital into the property, because the landscape may be very different in a couple of years' time. And so your options will be different off the back of that. So one potential consideration would be maybe an offset mortgage, whereby you essentially have an offset account attached to the mortgage. So let's say, round figures, you've got a £300,000 mortgage, you have 100,000 in the offset account, where you're only essentially going to be charged interest on 200,000. So you're reducing what you're paying, but you're keeping that liquidity. And the other benefit is, our team works with an awful lot of self-employed clients. And when they've got quite a hefty tax bill, you need that capital to pay off that tax bill at the end of the year. That's quite a good use of the money. I'll just caveat this to say, a lot of people have offset mortgages, but they don't use the offset facility. and they're ever so slightly more expensive. So they're good if people use them.
Interesting. I mean, there's been a huge amount of media coverage in, well, the last 6 months plus really on this as rates have continued rising, in some pretty enormous sort of headline figures shown on some of this. I mean, how, when you pick up the Sunday papers, how accurate do you find some of the stories on this and some of the reporting on this?
It's accurate to an extent. Now, a lot of the figures that's being reported, the media portrays 7 to 9% interest rates. Well, yeah, to an element, that to an extent, that's correct. However, that's looking at the standard variable rates, i.e. the product you move to when your current rate ends. Now, that's always much, much higher. The view is that you would actually, of course, remortgage away from that onto a new product. The reality, in terms of what we're really seeing, is some retention mortgages, i.e. You stay with the same lender, you can get on a variable rate potentially 4.8%. That was the lowest. And again, it's changing every other day. The goalposts are constantly moving. And a fixed rate potentially around 5%. So, the market presents this, and yeah, for some people that's reality. But there's a much bigger story behind that.
We read a lot about sort of average rates in the market, and sort of reports taking a wide spread and almost the middle rate and things. I mean, is that what clients should be aiming for, or is it about sort of beating the average? What should we be benchmarking our rates against?
Everyone is independent and idiosyncratic from everyone else. Every case is unique entirely. So I'm trying to be very careful with how I word things, because actually what I say now may not necessarily apply to many people listening. So the sort of answer to that is every case is unique. Everyone will have certain options available to them that other people just wouldn't have available, be it fixed or variable rates. So when I'm sat here saying, 5% 9%, there is no average. There is somewhere in between. And it really depends on credit history, loan to value, the current valuation of the property. So what I would really emphasize there is, and again, I'm not trying to sell my services necessarily, but a conversation with someone to say, where am I? What are my existing options with my current lender? What is the whole of market saying as well? And I'm going to just touch on that point very briefly, whole of market. So if you're going to speak with a broker, just try and make sure they are whole of market, i.e. they can look at every lender that exists out there. If you go to your bank, you'll get your bank's products. If you go to a panel broker, you'll get a finite number of products that they use from 5 or 6 banks. With whole of market, of course, you've got everyone. And a good broker will be able to see your existing bank's products, what they can provide, the whole of market, contrast that against, again, short-term planning, but also long-term. Where is this going to leave you in 5-10 years? Are you going to start a family in a couple of years' time? What's that going to look like later down the line? That then will start to give you a few cards, and you can make quite an informed decision.
When we mentioned a couple of options earlier on, something that clients come to me a lot of the time with, I mean, potentially sort of having big investments behind them as well as the lending, obviously repaying and redeeming the mortgage, whether immediately or whether a fix is up, is increasingly something people are looking at as rates are high and actually investment returns have been relatively poor over the last sort of year and a half, certainly in 2022. I mean, are there benefits to doing that? Is that something that people should seriously consider? Or
I'm always loath to suggest tying up capital in the short term and just redeeming mortgages in full, for instance. That's always a consideration. But I would always also look at your ability to gain or secure a new mortgage. And again, longer term view, because actually you may be sat on a product that in the current landscape, you wouldn't be able to get again, simply put. And if you're looking to purchase a property, or upscale, upsize in a couple of years' time, and you're thinking, well, maybe I'll repay the whole mortgage off now. In a couple of years, I can remortgage and get the bigger property. Well, you may not be able to get that mortgage in a couple of years for whatever reason. So having an independent view to say, where are you? what's my honest gut feeling about criteria and where this currently would leave you? Is there value to having this mortgage in place? And if there is, and Chris, I'm going to put this question back to you, what potential options could there be to use that capital instead of paying off a mortgage?
Yeah, it's a good question actually, because we've had a lot of clients, certainly on fixed rates, for example, who are concerned with where they might be in a year or two coming off a fix, which actually in years gone by may well be locked in at 1.5%. I mean, with options for clients of even keeping risk-free capital now that you can return potentially 5%, 6% on cash. I mean, actually another interesting one that we've been looking at a lot recently with clients, certainly on interest-only mortgages, is gilt portfolios. So gilt investments for clients at the moment, again, held to maturity. These are government-issued debt, so as risk-free as we hopefully can find. I think if UK PLC isn't repaying their debt, we've probably got bigger things to worry about. But recent interest rate rises have led to some fairly interesting pricing of these, which is leading to again sort of 5% plus returns, actually largely tax-free for clients. So even if you're not sort of investing for that long term, I mean, I think making sure there's some shorter term options there are more valuable than they've ever been. Back when a savings account was getting you sort of 1%, 1.5%, getting that extra sort of 0.1, 0.2 perhaps didn't really sort of persuade many people to action. Actually now, when you're looking at sort of 5%, I think making sure you've got cash deployed in the right place, and actually whether that's in a business for commercial lending, which I think we might come on to in a moment, but it now makes a really meaningful difference when you're holding large cash deposits and needing to keep those liquid funds. I mean, I mentioned sort of commercial lending. I mean, we've spoken a lot primarily on the residential side, but it's the commercial market going through sort of similar things. We'll have lots of clients out there and people on the call with commercial lending needs or buy-to-lets and things. Has it suffered in the same way?
The first thing I'll say is the commercial market is still very positive. Lenders still want to lend money. That's not changed. The main point is lenders are now very much going to the book. And what I mean by that is they're looking at their criteria, they're looking at their lending policy, and they're pretty much sticking to it. And they're not really using their discretion around that. And that's their way to manage the risk. It doesn't mean they won't lend. It just means you need to make sure that your story and everything you're currently doing, your past, what you're doing today, and what you're going to be doing moving forwards fits with the lender. Another point on that is not all lenders are made equally, of course. So what one lender may jump on 100%, another lender will completely turn away. It's quite important then to have several conversations with several different lenders to say, this is what we're looking to do, this is what we need, can you provide that? So we look at a couple of things. Cost, of course. How much or which is the cheapest lender? Longevity in the actual lending. There's no point in going to the cheapest if actually the implications are massive in a couple of years' time and the potential costs to exit are really restrictive. So there's a wider conversation there.
Where we've got, I mean, that's an interesting point of how to find the appropriate lender and actually maximize the chances of getting the offer that you're looking for. I mean, once you've actually sort of found that lender, how about what are you doing on an application process to actually make sure that's going through as smoothly as possible? I mean, we do still see some very quick offers coming out, but at the same time, there's a lot of clients who have been out there who potentially going through this process for months. I mean, are there ways of making that a bit easier and a bit smoother?
Direct conversation at the very get-go with either the underwriter or the business development manager. Because if you can get the people internally on side and really paint the picture for them, it makes their process much easier as they start to underwrite that case. The underwriters are people. they will listen to what you're doing and the logic behind what's going on. So if you can have that conversation and really present the narrative to the underwriter in a positive light and spell out what the client is actually doing, well, it makes that process far easier. And if they then have questions, the capacity to be at the other end of the phone pretty quickly, so they know if they have, right, we just need to tick these things off, 3 things off, and then we can probably go forwards. If they have the ability to call the broker, whomever it's going to be, then it's more likely to get through quicker. Just another point on that is presenting, and I can't emphasize this enough, presenting a fully packaged case, i.e. you found the lender, you've got the best rate in the market, and it's not restrictive in terms of the actual policy or the terms of the lending. Provide everything in one hit to the underwriter, everything that they would need, but not too much. And I'm going to sort of explain that a bit. Lenders will need a list of maybe 7 documents. Okay. If you give them more, they will look at more. They will look at everything when they don't necessarily need that additional information you're providing them. That they will always look at it. That may be the point where they decline a case because they've seen something they don't necessarily like, and it's something you didn't necessarily have to give to the lender. So I will always speak to the underwriters or the BDMs first, pre-approve a case, essentially get it, a conversation and say, yes, we're happy. Fully package that case, send everything off in one hit, but don't give them too much. I ideally will have everything and more so that I need in the background. So if the underwriter then picks up the phone and says, hi Matt, we need this and this, I've got it, I can send it straight over, but I haven't preempted and given them too much to start with, or given them a reason to say no.
We've had a couple of questions come in, which I might sort of jump on to certainly the first one now. I mean, a lot of people out there, and this is around first-time buyers, and what advice you'd give to a first-time buyer looking to, purchase a property in, the next year and a half. I mean, relevant to a lot of people, but also, clients' children. We have a lot of these kind of questions coming through. I mean, where's the starting point for them? Because, I can look at myself with my, current mortgage and seeing costs going up, and I remember buying my first property and sort of feeling that actually it was such an expensive sort of goal to attain.
Yeah.
I mean, what's your sort of advice for anyone looking to sort of get on the property ladder?
Start very early and have a conversation. Again, not trying to sell my time, but have a conversation with a good whole of market broker at least a year before. And I liken this to a ship. If you change the course of a ship's direction by 1 degree 12 months beforehand, it will be in a very different place at the very end. So what does that mean? Of course, everyone mentions credit, get a credit card, make sure that's paid off. Well, actually, lenders look at a bit more than just the numbers. They look at what's behind the scenes. So are you taking payday loans? That may need to stop because lenders hate that. How much of your credit you're actually utilizing? If it's up to 80-odd%, lenders don't love that. So try and keep it around 60 if possible. There's been new products, there's sort of newish now, that are 100% lending. They are certainly an option. They're quite expensive. So actually, if you can actually accrue the deposit, even a 5% deposit earlier on, you're going to, again, long term, you're going to make, or you're going to save so much more. And actually your capital appreciation will be that much better that when you remortgage in, let's say 5 years time, your loan to value, i.e. how much you borrowed to the value of the property, will be much lower, as long as property prices come up, that is. And then the costs will come down massively. There's, of course, go on, Chris.
No, we had another question just come in on that. You talk about sort of finding a broker. Actually, Victoria just asks, where do you go about finding a whole of market broker and making sure they're whole of market? I mean, obviously, you're sort of sat here, so go for it. But what are the questions to ask your broker to make sure that they're going to be, frankly, the right type of broker?
Yeah. So of course, I'm just going to say we are whole of market. So I always welcome a conversation, and I would expect any other broker to as well. So more than happy to have a conversation or a chat around that. Otherwise, when you speak to a broker, make sure they give you their time initially for free. if they're trying to charge you to speak to them, find someone else. Most brokers, I would expect, will give you at least half an hour, realistically, is probably more useful, just free of charge. Look at what you're doing, what your plans are. How do you find out if they're whole of market? Ask them. They need to tell you. The other thing is ask for the terms and conditions or their engagement documents, because that will very much detail how they get paid and actually what they can use. If they're a panel broker, if they, I wouldn't expect brokers to tell porkies and say I'm whole of market, where actually they're a panel broker. But if you've got that terms and conditions document, you can just go through it and look.
Got another question for you, and thanks to everybody for sort of writing in your questions, and please keep them coming. We'll put Matt on the spot with a few more. Mentioned sort of, and this was on commercial lending, although actually I think it applies equally to residential lending and for individuals looking at packaging up an application. You mentioned sort of holding back information. I mean, have you got some examples of maybe what you wouldn't disclose, or you'd be careful sort of being a little bit too open on the application?
Accounts, potentially, so business accounts, and this applies to commercial or residential. So let's look at commercial briefly and then touch on residential. A lender may not even want to look at the accounts. They may look at other pieces of information to qualify the income or the cash flow of the business. And your business may be structured in such a way that you've got directors' loans, for instance, so the business is essentially not making a profit. Some lenders understand that, they're grown up and they go, fine, yeah, we understand what you're doing, whereas others just will not take it. And they won't ask necessarily for the accounts, but if you give them said accounts and they see that, they'll just decline the case. It's sometimes around how they're regulated. So they may have to hold excess cash in the background. So you see this a lot with adverse credit, for instance. If you have someone who's missed a payment, and by the way, if you have, there's loads of options available to you, so don't panic. But if you've got someone that's missed a payment, they're an adverse lender or an adverse client. So a bank will have to hold more capital in the background to service that client base, so they'll charge you more. So touching on residential now, again, some lenders, for instance, will look at tax calculations and tax overviews, and that's what they'll use to evidence the income. Again, if you provide them the accounts, they may say, well, hold on, we don't like the look of this. Another may be if you are paying yourself dividends. Some lenders won't take dividends. I don't know why, but if you provide them the accounts and then you provide them tax calculations and it shows a lot of funds being paid in dividends, they may decline the case. So the very succinct and easy answer to this is just make sure, either if you're doing it yourself, that you know the lender's criteria, know what they want, and don't give them any more than that. Let them ask for it if they want it. Or if you're going for a broker, make sure they've got the experience and they've done it before, because a broker should be very honest to say, I specialize in buy-to-let, residential, commercial, or whatever, or one of the three or all three. If they dabble in buy-to-let, then they won't know the lender market. They won't know BM Solutions are very good for X, Y, and Z. They won't know that the Mortgage Works have really low product fees, whereas Skipton have massively high product fees. I could go on. Just one more quick point. Just touching back on adverse credit, because I have a lot of conversations around this, and it's quite difficult because some people just by no fault of their own. Klarna, we find quite a lot. People have missed a payment. Your lender pool goes from that to that. So something to consider is look at your credit report, but look at all 4 credit agencies, because you may be absolutely terrible in the eyes of Experian, but fantastic in the eyes of TransUnion. So on that basis, we may then approach a lender that uses TransUnion, because you could get a pretty standard mortgage potentially, whereas otherwise you wouldn't be able to get it with a different lender.
And this is presumably good advice. Well, good advice for anybody, but certainly those trying to get a first mortgage. You mentioned sort of start early, and actually tidying up a credit file is something which actually we've helped a lot of clients sort of do a year in advance of a mortgage, making sure that by the time you get to that application, everything is as clean as it can be. You mentioned sort of packaging up these apps. Is this primarily just to avoid or to not give an underwriter the easy way out here for an easy decline?
Yes, in short. So you'll stop the underwriter, because anything you give the underwriter, they'll look at completely and they'll take it apart. So yes, don't give them too much. The other is speed. I'm not trying to sit at the other end of the screen bragging, but I got an offer through the other week in about 9 days, and that's including weekends. So, and that's simply because I'd had the conversation initially with my BDM. Then I spoke with the underwriter and I asked them exactly what they wanted. So in this instance, the client worked for an LLP, a limited liability partnership practice, and they couldn't get the business accounts because they couldn't get the business accounts. So actually, we could get through that with an accountant certificate just saying, we expect you're going to get X amount this year. That was enough. So I could then provide that fully packaged case immediately. The underwriter came back the next day, one question, instantly answered. And you pretty much then you've got through underwriting. It's just waiting for the offer to be generated.
Hello, another couple of questions come in. So one talking about sort of mixed mortgages, so where, you know, portion on capital repayment and a portion of interest only. If you're considering overpaying on either of those or potentially both, is there an obvious answer as to which one?
So there's I'm going to break that down into two sort of further questions on that. One is what's going to save you the most money on interest, and the other is safety. So in terms of what's going to save you the most money on interest, is case by case is the honest answer. So arguably interest only, because then you're reducing what you're paying. You know, if you reduce your capital repayment element, you're going to pay the same every month. Whereas if you repay the interest only element, your interest, so that proportion will reduce slightly. So your outgoings will reduce the next month, and you can essentially snowball it back into that interest only element and pay that off. So that's the first point. The second is, again, cash flow and safety. What paying off the interest only element is going to give you more security longer term. Again, like a broken record, but where are you going to be in 10, 15 years? Do you want the burden of having that element at the end of 15 years to say, I still owe X amount of money? Again, just one final point, and this is where Chris, someone like you would come in quite nicely, is short term, the interest only element might be somewhere to put the capital and pay that off. Whereas actually when the rates eventually, when the rates start to come down, benefit of that will start to be negated a bit, and there may be something else you can do with your capital to potentially use that instead to pay off that interest only element in 10, 15, whatever it's going to be years.
Yeah, I mean, I think that raises an interesting point that a lot of clients have sort of maybe found some difficulty with recently is making that long-term view based on, you know, what's been pretty tricky, which may be an understatement, short-term markets and events. I mean, one of the big things for us is, you know, is really having a look at the planning element and using mortgages or using lending as part of that wider planning, and actually being able to have a look through, you know, beyond the 1-2 year time frame, and actually showing what these impacts are 10 years down the line, perhaps 20 years down the line. And there are options of, you know, giving up. We've had clients sort of talk about surrendering ISAs, for example, and yes, they may rebuild them, but actually really considering what those implications are, you know, beyond the 1-2 year time frame, which is the easy one that a lot of people I think consider at the moment, and actually translating that into, well, that's fine, but what impact is this going to have on me, you know, when I'm 60, when I'm 65, when I'm 70? Is this going to impact retirement? Is this going to impact the income that I can start generating? Being, I think, very careful of making those big long-term decisions based on, you know, very short-term, you know, in the grand scheme of things, short-term movements.
And just on that topic, I'm going to jump on the back of that, and I'm not going to give, you know, exact figures and details, otherwise our compliance team will shoot me. But again, longer-term view, what else could your money be doing? So pensions is a good topic there. Actually, could you get tax relief on the back end of putting money into a pension? You know, we recently had the annual allowance bump up from 40,000 to 60,000 a year. Lifetime allowance is now abolished for now, depending on anyway, that's a different topic. But your capital and the interest only element of that mortgage, for instance, could it be earmarked for something else? Actually, in a few years' time, or in 10, 15 years' time, would you downsize? Do you need to pay off that interest only element? Could you do something else with the capital? And it's every case is idiosyncratic, because actually that may be really risky if the property is not worth that much, or you've got other plans, or actually it may be a really good potential plan. Again, with buy to let, do you keep a load of those on interest only, and then at the end of however many years you just sell down a couple to repay them, or do you use the capital for something else? So those are all the really value add, it's sort of like cheesy catchphrases, isn't it? But that's the value that you can really gain from having a wider conversation with someone to say, what can I do?
We've had a couple of questions that I might do together on sort of credit scores and credit scoring agencies in particular. I mean, the first part of this, does having an account with any of these agencies actually impact your credit file? And you see a lot of these adverts for paid services from these. Is that needed? Do people need to pay to get their credit scores, or is there any value to that?
There's a couple of providers that I really like, where it's that whole, you can trial it for 30 days for free and then cancel it. I tend to say, do the 30-day trial and then cancel it. All we need is that PDF that tells us where you currently are. That's it. You don't need to necessarily pay for it. If you want to, by all means, but you don't really need to. It's a cheeky way to get a snapshot of where you are. And there's loads of providers out there. So you can do that. Again, first time buyers, do that at the very start potentially, and then do that at least 6 months before the end, or before you plan to buy the property. In terms of impacting credit scores, most of them will leave soft searches on your credit score, which shouldn't impact it. So something certainly worth to check. If it leaves a hard credit mark, that's fine. It's not an issue, but lenders will see that. They won't care is the honest answer, most likely. Just again, on this point, in terms of credit impacts, if you go to several lenders and you get declined by several lenders, each of those is a hard mark on your credit history. So if you get 3 declines in a row, four declines, maybe your broker's not looked at criteria properly, or whatever the reason. When you go to the 5th lender, the underwriter will see that. And even if the case fits with their criteria, they may then be incentivized to ask the question, why have 4 other banks declined you? So sort of related, but what's the short answer there? Make sure you really understand the lender's criteria, and you understand the lender is almost certainly going to take you before you go to them. If it's a decline because there's a down valuation, which we do see some of, that's fine. Fully package that for the next case, so you can have that, you can approach and broach that topic before it gets asked.
There's a question about future affordability here. The question is, how open are lenders to, or where low fixed rate mortgages are ending and future affordability is perhaps questionable, and affordability has tightened up a bit in sort of recent years anyway. Are there still options of funds deposited as a guarantee or offset by parents? I don't know whether this is and this is certainly going to be relevant to first time buyers as well.
Yeah.
Is that still available to people?
It's a really, really good question. Yes, guarantor is sort of an old term in the mortgage industry nowadays. The equivalent would be joint borrower, sole proprietor, which a colleague said sounds like a 70s rock band. But joint borrower, sole proprietor essentially means it's a guarantor. You've got multiple people using their affordability to get past the mortgage. Joint borrower, sole proprietor, you've got one person who lives and owns the property. So yeah, absolutely. If you've got, bank of mum and dad, and they can help in the background and help you boost your affordability, that absolutely works. Again, proper broken record. What impact is that going to have on mum and dad in this instance when they need to remortgage in a year's time? It may not have any impact. It may have massive impacts. So not just reviewing, can we do it now? Yes, fantastic. But what are the longer term implications of doing that? Yeah.
I think we've got a lot of people who will be needing to make these decisions at some point soon. If they've been lucky enough of being on sort of long-term fix, then actually over the next year or so they will start coming to an end. I mean, if you had to give some takeaways to everybody today of the key tips, the top tips of actually what people need to consider if they're coming up to this, what's your advice for people?
Whole of market. Look at every lender that's out there. because your existing lender may give you a really naff rate, or they may not necessarily take you on. But several other lenders may welcome you with, open arms. So make sure you look at all of the lenders. Go to a broker that will give you their time. If they're trying to rush you through the process, or they're trying to charge you for an initial conversation, there's lots of us out there. So go to one that will actually sit and listen to you and listen to the longer term plans of what you're doing. Affordability, there's a real tendency to try and not time the market necessarily, but can I get the best rate and how do I do that? Look at the implications of, what if I lose my job? Where is this going to put me? Actually, do I need not just the mortgage to be consistent for a period of time? Are there wider planning considerations around that? Like, again, it's not the most interesting or sexy financial product, but life cover. If I'm off work sick, can I still pay that mortgage? Wider conversations about what to do with my money, because paying off the mortgage in full is certainly an idea, or paying off a massive chunk to reduce what you're paying is certainly an idea. Are there other options? For instance, the offset account could be a really neat solution that satisfies that need quite nicely. I don't know if you was going to ask, Chris, I've got a couple of the pre-written Q&A, so I'm conscious of time. I'm just going to touch on those very briefly.
Yeah, go for it.
Best way to get a bank to roll over a mortgage for 3 or 6 months. So I'm understanding that that's your product's going to come to the end of its overall term, or its initial product, and then you just want to extend it until you sell the property or do whatever. You can certainly contact the bank yourself. Again, I'm not trying to sell my services, but if you could get a broker to do it on your behalf, they may have more direct contacts within the bank. So their BDMs, the business development managers, they want to keep the brokers giving them business. So they want to help as much as possible. So they may be able to sweeten something to get the underwriters or get the bank to agree to extend the term. If it's the overall term of the mortgage, i.e., a 15-year, and it's now whittled down to the very final few months, speaking to the banks, they don't want to repossess property, and the regulator has come down quite hard on the lenders to say, don't do this, and the banks don't want to. It costs a lot of money for them. So if they can see a really clear path that you've got a plan to redeem this mortgage and we're just waiting for X to happen and we can evidence this, it's always worth a conversation. Another potential is to look at a shorter term mortgage, so maybe a variable rate for a few months. Now, the reason I would suggest that, you've got the risk that, we expect interest rates to continue coming up, so a variable rate will increase. However, it will be a lower cost than the standard rate. It may avoid you having to find a huge amount of money to pay off a mortgage that ends in a couple of months. And again, they don't carry early exit fees. So you're not going to be stung on the back end in month 5 when you need to redeem the full mortgage.
Yeah, I think this all highlights the need for the wider sort of planning piece and considering, actually everything else that goes around the mortgage. I mean, we've flown through 45 minutes. So Matt, thank you. I think we'll wrap it up there. I mean, thanks for everyone joining today. I mean, it's obviously quite clear by the number of people who have joined the webinar just how important this is for everybody. Look, we're here to help on this. Making the right decisions, I think, has certainly become a bit harder in the last year and a half, and where sort of rates have gone to and costs, actually it's probably never been more important, certainly not in recent times. Thanks to Matt for joining. Please don't hesitate to reach out. We've had a couple of questions that have come through which we haven't got to, but we're going to follow up with some answers to people. And yeah, please reach out to me and Matt as well, and we'll sort of help where we can. Yeah. So thanks to Matt. Thanks to everybody for joining, and have a good day.
Yeah, likewise. Thanks, Chris. Thanks, everyone.
Thanks, Matt. Bye.
Cheers.